Let's get caught up on the macro landscape, how to play the stock market chop before the pop. You guys know we have been looking for a pullback in the market. We just got that with the latest CPI data, but let's go over the macro here because it is a very, very interesting setup. So listen, the S&P 500, it's rallied over 20% since the late October lows. With the S&P north of 5,000, it's one of the steepest 3.5-month rallies of all time. Remember, we were telling you a big rally was coming. It is here, folks. Don't be surprised. But here's the deal. Rate cuts, they may be delayed, but they won't be denied. Let's look at the evidence. We got three things to focus on here. Number one, you can see that the Fed funds rate 5.5%. It has been flatlining since late July. There's no more rate increases that are coming, folks. But let's see what else could be holding up the rate cuts. The first thing is US GDP growth. This is in green. It's starting to spike. Look, when growth is expanding, that means that the Fed could hold off on cutting rates. But the main driver of interest rates is inflation. This red line right here, you can see it's tailing off. That's the core PCE. This is what the Fed likes to look at. As we said earlier, they may delay the rate cuts, but they won't be denied. So it's coming. All that money that is piled into money markets, it's going to look for a new home. We believe that's going to be into equities. But now that we know that macro picture, let's get at the institutional money flow picture. We love the big money index. It is the guide. It's the market's North Star. What do we know? We know that we were extremely overbought December and January. Now the BMI is starting to tail off. You saw that CPI report that came out recently. Markets were down big across the board, but money is starting to get back into equities. BMI is no longer overbought, so we do see some opportunities in small caps. But here is the deal. We want to keep revisiting this. When the BMI falls out of overbought, since 2009, the S&P 500 tends to struggle. We saw that on Tuesday's CPI report. S&P was down. The Russell 2000 was down 4%. This is why you got to pay attention to money flows. So how do you play the stock market chop before the pop? Well, let's also remember what is going to happen later this year. We know that the Fed is going to cut interest rates. And if you go all the way back to 1921, we're talking about 100 years of data. The Dow Jones Industrial Average soars after the first rate cut. So 6 months later, the Dow Jones is up 10%. 12 months later, after the first rate cut, it's up 15%. These are market beating returns. This is why you're starting to see stocks surge, because they know what's coming, right? You can't wait for the news to happen. You got to get ahead of it. And that's why stocks are performing very, very well lately. So let's go ahead and talk about the big gorilla in the room. We know that mega cap tech has been leading this rally. It's just been breathtaking to watch. But when you consider that the earnings per share continues to go higher and higher, these are expectations. Now you see why people are plowing into mega cap tech. You look at this versus the S&P 500, which is, it's ticking up a little bit. But if you look at the equal weight, the EPS growth estimates have definitely started to trail off. So listen, we know that stock prices follow earnings. That is why the juice is going into mega cap tech. So let's look at the S&P 500 year-to-date sector performance. Technology, comm services, that's basically tech. Those are where the big returns have been. Healthcare has been great, which is another sector we like. And we also like financials. Interest rate sensitive areas like real estate, utilities, they have been hit hard compared to the other groups. They will have better days ahead once interest rates start to come down. So what is the main takeaway here? Focus on the strongest areas: technology, industrials, financials, discretionary, healthcare. Those are our top 5 ranked groups. Those are areas that have the dividend growth. Those are areas that have all-star stocks in them, which we talk about a lot on this channel. So if we have to bring it all together, expect a little bit of chop, right? We know that there is a delay on the interest rate cuts, but they will not be denied. Any type of pullback, we would be an aggressive buyer. We want to be focused on tech names, industrial names, financial, discretionary, and healthcare. You guys hang in there and always remember to think long term. That is how you win this game.